two or three new models out there as well, one with an exchange sort of slant to it. So that a lot of innovation both in the existing players but also with the newer ones. Do you think you're doing a better job than the existing players are?
So look, first of all, I think it's probably unfair on everyone to say that we're all in the same bucket, we're aggregators. So number one, I think aggregation, choice, different types of venues creates better choice for the broker dealers, for the clients out there. Different models, competition is good. We're happy to compete. And I think to the incumbents, so talking about the new kids on the block or the proliferation of venues or new venues out there, it doesn't necessarily follow that the best model 10 years ago is the best model today. So I'm an exchange evangelist. We fundamentally believe that exchange execution is the best deal for the client. If you look at the CME, you look at eBay, you look at the LSE, it's clear the world is going towards that method of execution. But still, we have to exist within a foreign exchange ecosystem. And I think we definitely bring a different level of choice to the clients out there. Now, ultimately, you've got to choose what's best for you. And I think what happens through all of these panelists up here and all the different offerings is you create different choice, more choice and more competition for you as the client. And that has to be a good thing.
I mean, I think you pick up on an important point there that within the institutional world, relationship is extremely important. I think that's still a relatively new thing from the retail world of understanding that relationship element.
Let's be clear about
I would
this
actually
can't be about relationship pricing.
Yeah.
I mean, this is what everything's coming down to on this panel. So let's be clear to retail brokers, especially new guys setting up, shouldn't be priced differently according to where you are on your development. That's the whole point. If you go and trade equities, you go and trade futures, no one's saying this is one price for you, this is another price for you. You've got access to that liquidity pool. So surely, and also, I've been there, being the new broker on the street. You don't know what your flow is going to be tomorrow, or the next day, or 2 months' time, or 3 months' time. So someone presupposing and saying, okay, well, this is the liquidity pool for you, as from what you've told me, that cannot be right. So that's the whole principle of an open order book. Well, obviously we run, and other exchanges and other asset classes run. So I think if we are all harping back to relationship pricing again, we're stuck in the dark ages a little bit.
I think there's probably one for David. The last look was created as a means to an end, right? It was a way for the banks to protect themselves because the buy side had created far better technology than what the banks had. And they needed a way to catch up. Now, most banks have done that, but it is still around, and I think it's perhaps incorrectly thinly masked as, no, you just missed the price. But for the people in the audience, call it last look, call it you missed the price, call it whatever, it means that their customer didn't get the fill. Now, some of you have providers that have last look. One of you doesn't. What's everybody think about last look?
I'll take that first.
I know what you think, but
look,
let's open it up.
First of all, I mean, I think it's clear, you're absolutely right. It was a business solution to a technology problem. And I think I can't speak for other venues. I think sometimes it works for certain providers and certain clients. But to be clear, as a regulated MTF, all our market makers, all our liquidity providers connect the same way, and no one has last looked. Now, many of them are in the audience. I think if you ask them, they're not seeing a decrease in their yield. They're not seeing any problem with the prices they're providing, the quotes they're providing, without last look. I think technology's caught up. Put simply, if trade latencies are in sort of the region of 3 milliseconds, market makers can cancel and replace in 1.5 milliseconds. I think the concept of last look is will go by the wayside. To a brokerage client out there, how does it manifest itself? Put simply, it's going to be the consistency and quality of the execution you get. If you trade on an exchange or an open order book, you'll consistently get the same execution. You won't sometimes be filled in, if you're coming from this part of the world into a London or New York matching engine, it won't sometimes be confirmed to you in 120 milliseconds and sometimes in 600 milliseconds. It would always be the same. Put simply, in an open order book, what you see is what you get. What happens is when you see the inconsistency in your fills, when you see greater levels of slippage, what's happening there is that the first price you've seen hasn't been hit. So you've moved from liquidity provider 1 to liquidity provider 2 to liquidity provider 3, 4, and 5. Because those liquidity providers have last look. I think for you as clients, it impairs your ability and your profit potential effectively, and the consistency of execution you also offer your clients. So that's why, look, I probably sit here in a minority, but it's a position we're comfortable in. We don't believe last look has a long-term future in the spot FX industry.
What's the most important thing on the execution side that a retail FX broker should be looking at?
I think it's pretty easy, and I think you know the answer as clients out there. First thing you must look at is your total cost of transaction. A lot of that's going to come back down to quality of execution. So by all means, measure it. Make sure everyone gives you the tools to do that across the venues. Compare and contrast. I'm pretty certain that experience of exchange-style execution will lead you only to one answer.